Hi, everybody. Scott Riley, the Market Update Desk, August 12th. Well, we got the big inflation, we got the big data for the week, which was CPI today. We'll break that down in more depth than what we did this morning. As we're looking at everything, stocks are higher and mortgage bonds are slightly lower as we've gone through the beginning and middle part of the day. One of the things that was announced was President Trump announced the new BLS head, and that's going to be EJ Antoni. We have seen him on CNBC before, and he's brought up some good points on the inflation and labor data. Now, we hope that he's going to be a good appointee, but at the end of the day, what we're just asking for is accurate, reliable data within the numbers and realistically a change within the methodology and process that they use to come up with this data. Now, within the CPI, we showed that overall headline inflation rose 0.2%. That was in line with expectations. Year over year, actually remained flat at 2.7%. That was actually on the better part of the estimates that we saw. We saw as high as 2.8%, but we came in at 2.7, which was flat. Helping the overall number was a decline in energy prices, which was nice to see. Some of the price increases, there have been some muted price increases due to tariffs, but they're having a very small overall impact on inflation figures, at least in this report, we should say. Some of the figures look large when you see the headline of it. So, for example, furniture and bedding rose 0.9%, and audio rose 2.2%, and photographic equipment rose 1.2%. But because the overall weighting of these specific areas are very, very small, it only caused a minor increase to overall inflation. In fact, it was 0.0086. There will be parts, there are also parts of the overall economy that show declines. Specifically, apparel was expected to rise, but it actually declined. Now, the core rate, which strips out the volatile food and energy, increased by 0.3%, which was on the upper end of the estimates. Year over year, did go up a tenth hotter than the market planned, rose from 2.1 to 3.1%. I'm sorry, 2.9 to 3.1%. While there was not a big impact from tariffs in this report, once again, shelter, which accounts for 44% of the overall reading, it showed up 0.23%, which was pretty substantial within the total. Now, helping the reading a little bit was lodging away from home, which was it's just a very imputed number that fell 1%. Some of the other areas that caused inflation to rise were airline fares, which rose 4% this month. Used cars and trucks and medical care also increased. Everything else only rose by 0.07 month over month and 0.89% year over year. So overall, they remained tame, based on the numbers above. But what continues to hit us is these total shelter costs, because it makes up such a big percent. The 44% of the entire reading is made up of shelter costs. So when we get owner's equivalent rent, for example, it has a big lag and a lot of imputed data. It has a skewed impact on these numbers, which don't help us. On the technical side of the market today, we see mortgage-backed securities, mortgage bonds are hitting support of 100.76, which is now acting as a ceiling of resistance. So there is some room to the downside. So we've broken beneath that level, and it's now creating a top level resistance. 10-year Treasury broke above its next ceiling of resistance, which was 4.29. If this continues to stay enclosed there, the next ceiling is going to be 4.33. We haven't moved a ton, but we have these new ceilings and resistance levels that have now taken place. On the day, mortgage-backed securities are up 8 basis points. 10-year Treasury stayed pretty muted at 4.30 as I'm seeing it's up 2 ticks. So we made it through CPI. We're still within a pretty tight level. So good rates are still out there, and we're getting very active. Give us a call. We'll put our experience, knowledge to work for you so that we can help get your offer accepted. 616-293-2189. The Market Update Desk with Scott Riley. Have a great afternoon.